Welcome to Yield Nerd, an educational show about how you can acquire and manage yield.
All right, now let's talk about what kind of assets are potentially going to make it to your growth portfolio. But before I do that, I thought I'd give you another bright idea to get your mind working on how to think through growth investments. The year is 2008. Here is my bright idea. You know that beautiful home you live in? You keep it stocked with good stuff, with shampoo, with towels, and all the other stuff, cable TV, and you leave the house, and a random person and five of their friends you've never met will stay while you're gone, but hey, you can see their ratings. And if you believed in that wonderful idea and you're willing to put money into it, it will grow bigger and bigger and bigger, and you would make a huge multiple. The point of my illustrating such examples again is it is very hard to understand exactly what is going to make a difference and what is not. And that is why you need to understand the thesis behind a growth investment. So maybe you are a very early stage investor, maybe you're a later stage growth investor. You're better off trying to understand the basics and the vital organs behind the growth investment so you can make better decisions. So let's get behind that. If the company is yet to make revenue, meaning if it is a pre-revenue company, you would look for milestones. For example, did the company complete a clinical trial? Is there a big pilot? Did they get a patent? These are all walls around the company that help it preserve its competitive advantage. And you, the growth investor, would look for that and say, hey, is this something that gives me comfort? In the scenario where it is a company that actually has revenue, you're going to see what is the difference between their last year revenue and this year revenue. Do they have a lot of cash? How is their cash flow? Are they expanding their products and services? Or are they making good acquisitions? These are questions you would ask using publicly available information to understand the growth investment. In reality, there are three options available in the growth portfolio side of things. One would be the real early stage angel investing. There isn't a public market. It's not like you can call up somebody and say, would you like to buy my stock in XYZ company? My suggestion to you is to think hard and invest in areas that you know. If you have a background in chemistry, maybe look for companies in that area. Invest in people you know and invest in yourself. Is that an area that you are passionate about, that you think you have a learning opportunity yourself? And the general exit horizon, people would say, is about 7 years, and there is a high failure rate, so you have to be ready for that. If you're not an early stage investor, maybe you are a venture or a private equity investor. The criteria are pretty much the same. You are going to put money into things that you are passionate about. Maybe you like a certain field of science or a certain field of art or a certain field of social networking, and that is what you're passionate about. Ideally, you should invest with people you know and also something that you personally can grow from. And in theory, the venture and private equity side of the house could have a shorter horizon and a lower chance of failure, and that is for you to research and understand. Last but not the least, you can always invest in companies that have IPO'd. And in that scenario, you are indeed picking up after a reasonable amount of risk has been eliminated. What that means is a good chunk of the reward has also been eliminated. And there are ways to look at publicly traded companies that are still in the growth mode to understand how can you pick out the good ones and how can you understand where a company is potentially headed, and we'll actually research that together as well. So now let's ask those very questions. If I'm looking at a brokerage account, how can I make the decision of which criteria to use in order to screen growth investments? So let me review a handful, but before I do that, I want to kind of give a heads up that the content of this chapter is going to be somewhat elementary. To the extent that you are familiar with common terms in the market, feel free to skip to the next chapter. So looking in the public market, you are looking first through your own exit horizon. Do I want to get out of this growth investment in 6 months, in a year, or am I willing to stay for 5 years and 7 years and longer? The next part you're going to look at is how fast is the company growing? Are they already in the point of profitability? Are they trending towards the point of profitability? Do they have cash? What are the micro and macroeconomic trends with respect to the industry that company is in? And are there specific milestones that tell you that this may be an interesting opportunity for you to take that risk? And last but not the least, if the company's cash balance is decreasing and it is a growth investment, there really aren't that many options. They either need to issue more stock, which will decrease your upside. They will need to get a loan, which will make the company weaker, or they may have to end up selling the firm, which may or may not lead to the kind of returns you are looking for. So we're going to start reviewing a few basics before we go into a brokerage account and look at what terms you can search with. Some of the basics are terms such as market cap, price to earnings growth, and things like that. So market cap is pretty simple. If you had a company that had 1,000 shares and each share traded for $1, the market cap of that company is $1,000. In other words, if you spent 1,000, you can buy every one of the company's stock that is currently being traded. The second buzzword we'll review is earnings per share. Assume that same company that had 1,000 shares trading at $1 each had a profit of $500. What the market is essentially saying is the earnings per share is 500 divided by 1,000, or 50 cents. That is the earnings that they could potentially distribute to each shareholder. A couple more buzzwords and we'll be through to looking at the brokerage account. Price to earnings ratio. If the price to earnings ratio is the ratio of the price per share to the earnings per share, in our example, it would be $1 divided by 50 cents, which is 2. What that is saying is the market is willing to pay $2 for every dollar in earnings per share that this company is generating. The reality is today's markets are willing to pay $22 or more for every dollar in earnings that publicly traded companies generate, and that says a lot about how optimistic the market is, and some would argue rightfully so, and others would argue not rightfully so, and that is a decision for you to think through. Last but not the least, we're going to look at a metric called price to earnings growth. What this is saying is either on a historic basis or more commonly on a futuristic basis, how much of the price to earnings ratio is expressed as a multiple. Last but not the least, we're going to look at the multiple called price to earnings growth ratio. Let me explain that more. What this does is, using either a historical measure or a forward measure, we look at the price to earnings ratio and express it as a multiple of growth. Let me explain what I mean by that. Assume a company is expected to grow its revenue and its income by $2, and it has a PE ratio of 2. We would divide 2 over 2 and get 1. In other words, the ratio of price to earnings is the same as the ratio of growth, and that would give us the PEG ratio, as it is called, as 1. Many times, PEG ratios are computed as a forecasted ratio of what the market or analysts think the company could make in the next year, 3 years, or 5 years. And so there is a considerable amount of uncertainty in this area, in the sense that you may think the price is justified because the price to earnings growth ratio is 3 or 4, but that also assumes that the company is going to grow at a meteoric pace, and if the growth is not there, then you overpaid for that particular stock. The last but not the least important buzzword for any company is cash. If the company runs out of cash, we got problems. And this is a much bigger problem for pre-revenue companies, which may have trouble raising new cash. And if they don't have profits, they don't even have a PE ratio to hang their hat on. And so cash becomes king, and you are now betting on the management team to then generate new sources of cash and make a business case. And the odds of pulling through from that situation would most likely increase your timeline of exit. So that is something you need to very clearly think through. So what we have reviewed so far is that there is really no quick and dirty way to screen for the next big idea. We reviewed a couple of them where the idea itself sounds like not something that many of us would jump into. So we're going to pick up a couple of poor substitutes, as you will, using the buzzwords and the terms that we reviewed. For example, price to earnings growth ratio. We may say I want something with a PEG ratio less than 1, precisely because you don't want to overpay for that particular company. You may want to pick companies that have aggressive earnings per share growth, companies that have a solid return on equity ratio, and in some cases, you may want to also rely on the estimate of the earnings per share. And please remember that this is an estimate and there is a lot of subjectivity there, and there is some unreliable potential for counting on what may happen in the future. So you have to use your knowledge of the industry and your calculations to get to the final part. With that, we are going to wave goodbye to the growth portfolio, and we are going to focus on yield. And in the next episode, we're going to look at income portfolios, what kinds of assets are in an income portfolio, and start our deep dive into treasuries. Thank you for listening.
Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.